Welcome to the Stock Market Palantir. Today we are going to talk about OKLO. So, Oklo Inc. It's probably one of the most intensely scrutinized and volatile stocks on the market right now. It sits right at this really fascinating intersection. You have the resurgence of nuclear energy. You have this monumental and frankly insatiable demand from the whole AI energy infrastructure supercycle. And then you have the aggressive speculation you see with meme stocks. And this is a pre-revenue company. I mean, they're targeting commercialization for their fission plants by 2027, yet its market cap has been, well, just wildly fluctuating between $10 billion and $25 billion in just the last few months.
That extraordinary range, that's the red flag right there, isn't it? I mean, what we're seeing is extreme bilateral volatility, especially in this fourth quarter of 2025. We saw the all-time high, back in October? It hit $174.14, and then just a brutal, swift correction, trading all the way down into the $80 to $90 range by, early December. My whole point is that the current market price is just fundamentally disconnected from operational reality, and it's deeply, deeply distorted by the market's microstructure.
I see it differently. My position is that this valuation, while it's definitely volatile, I'll give you that, is irrational, maybe even a necessary pricing of future optionality. This company, it offers a tangible solution to this infinite demand thesis for baseload carbon-free power, especially for the next generation of AI data centers. The market is pricing in the potential for massive, necessary scale.
I'm sorry, I just can't buy that. Not as a justification for a multi-billion-dollar valuation for a company that hasn't sold a single kilowatt of power. We have to look under the hood here. I mean, when you actually analyze the microstructure data, specifically the FINRA data from early December, the off-exchange short volume ratio is just consistently hovering between 60 and 65%. And for listeners, that off-exchange short volume ratio, it measures how much short selling is happening off the public exchanges, in dark pools. A number that high, it points to intense institutional distribution. It means the big players are selling into the rally in these private venues, feeding shares to an eager retail base who are, getting internalized and buying on the public side. That suggests a really problematic transfer of ownership, not rational pricing.
I see why you're focused on the microstructure, and yeah, it explains the volatility. But let's get back to the strategic opportunity that justifies the massive upside, Oklo's vertically integrated owner-operator model. It's a crucial piece of the puzzle for solving this looming AI energy crisis. We're not just talking about a big total addressable market. We're talking about guaranteed demand. And this infinite demand idea, it's bolstered by really high-profile backing from people like Sam Altman. That translates directly into perceived guaranteed access to hyperscaler customers. Your Microsofts and OpenAIs. They solve the political problem and the customer problem at the same time.
Altman's involvement might guarantee attention. Yeah, but does it guarantee financing? Those are two completely different risks. The valuation disconnect is still staggering. This is a company valued in the multi-billions today that was priced at a pre-money equity value of $850 million during its SPAC merger. We are talking about a severe overshoot. And what's more, that owner-operator model you praise, it requires immense sustained capital. I mean, analysts are projecting a daunting $4.6 billion cash burn before Oklo even gets to positive free cash flow. And that's not until 2033. This means they have to do heavy future financing, which is exactly why the company just filed a $3.5 billion shelf offering.
And that filing is just a responsible financial management tool.
A shelf offering, and just to be clear for everyone listening, it's basically a registration with the SEC that lets the company sell up to $3.5 billion in new shares or debt whenever they want in the future. It's a tool for capital access, sure, but it also creates this massive dilution overhang. If even a fraction of that is equity, we're talking about, potentially 20% or more dilution? That just severely erodes the value for current shareholders.
But the execution risk here is being mitigated by some serious tailwinds. We all saw that dramatic surge after the Trump trade rally in November. I mean, nearly 50% in a single week. That signals a profound political shift. You couple that with regulatory tailwinds, particularly the push for the Advance Act, which is designed to streamline and speed up NRC approval processes, and suddenly the timeline to commercialization looks a lot more viable. Their tech, the liquid metal-cooled fast reactor, it has superior fuel efficiency and passive safety. That makes it smaller, 15 to 50 megawatt designs, absolutely perfect for co-locating right next to data centers.
A superior design doesn't just negate regulatory complexity. You mentioned the technology's advantage, but you have to acknowledge its core vulnerability, which is the reliance on HALEU fuel. HALEU, that's high-assay low-enriched uranium. It's necessary for these advanced small reactors, sure, but licensing a novel design is one huge hurdle. Securing a reliable supply chain for HALEU is another one entirely, especially since the global supply is right now dominated by Russia. That one single fact introduces geopolitical and operational risks that competitors using standard fuel just do not have to deal with. The current valuation prices in the frictionless removal of all these risks, which is it's highly unrealistic for a pre-revenue, pre-approval startup.
Okay, let's challenge your skepticism right at its foundation. The AI energy demand thesis. You're basing your bearish position on the idea that this infinite demand is overstated. So what concrete evidence do you have that suggests this looming energy crisis is not as bad as everyone projects?
I'd point directly to what I call the efficiency shock in chip design. Look, compute growth is undeniably exponential, I get that, but the efficiency gains in the hardware are moving just as fast, if not faster. I'm talking specifically about Google's tensor processing units, their TPUs, which are engineered to be significantly more energy efficient for AI tasks than the traditional NVIDIA GPUs that fueled this whole initial AI boom. And this isn't some theoretical problem. The market reacted violently to this. When the news broke that Meta was negotiating a deal to use Google TPUs, we saw sharp corrections in Oklo stock. That shows the market is acutely sensitive to any potential demand reduction. If efficiency gains start to outpace the sheer demand for compute, the premium that's attached to Oklo's capacity just evaporates overnight.
I would frame that risk differently. While efficiency matters, of course it does, focusing only on the power per calculation misses the fundamental bottleneck here, which is baseload capacity. Even if TPUs are more optimized, the sheer scale required for future AI infrastructure, training these massive, complex models far larger than anything today, that guarantees a need for more 24/7, 365 baseload power than our current utilities can physically provide. The grid is capacity constrained. Full stop. The recent news of a $500 billion joint venture involving the Trump administration, Oracle, and OpenAI, that validates the political and financial commitment to solving this power constraint with advanced nuclear. Efficiency is great, but capacity is the ultimate bottleneck. And only Advanced Fission offers a guaranteed carbon-free baseload solution at that scale.
But capacity requires sustainable capital. And that brings us right back to those market microstructure warnings. While you focus on political alignment, I'm focusing on who is selling. I'm just not convinced that their $922 million cash position and strategic financing plans are enough to mitigate these structural supply risks. You mentioned the low days to cover ratio, which, it currently sits between 1.3 and 2.5.
Which suggests shorts can exit pretty easily.
Exactly. Unless liquidity suddenly dries up. But let's just clarify what days to cover means. It's a metric showing how long it would take short sellers to buy back all their borrowed shares, right? Calculated by dividing the short interest by the average daily trading volume. A low number suggests a limited risk of a short squeeze, but that low number becomes almost irrelevant when you look at the surge in total short interest. It was nearly 15% of the float, 18.6 million shares in mid-November, and you combine that with the consistent 60+% off-exchange ratio. That high ratio strongly suggests organized institutional distribution. It looks like large players are deliberately using dark pulls to sell quietly into the rally, creating a persistent supply overhang that just keeps the stock pressured no matter what retail is doing. That is a severe market warning sign.
They are managing the capital cycle like a growth company has to. They have nearly $1 billion in cash right now. The shelf offering is there as a prudent tool for long-term access, not for immediate execution. A company this strategically important will find capital.
What's far more troubling, in my view, are the structural risks inherent in your argument about supply.
But that structural supply risk was accelerated by the price action itself. The aggressive volatility and the high prices, they actually triggered the vesting and lockup expiration for sponsors and insiders. That released a huge new block of shares into the sellable float in Q4, which only exacerbated the downward pressure we saw in November and December. The very structure of their listing means that extreme price performance automatically translates into more supply. It actively feeds the bears.
Okay, let's shift focus to the model itself then. If the core problem is capital, why adopt the hyper-capital-intensive owner-operator model instead of something simpler like a vendor or licensing model?
That is the crux of my skepticism. The owner-operator model means Oklo has to carry the construction costs, the regulatory liability, and all the operational risk on its own balance sheet. That directly explains the projected $4.6 billion burn rate. It's too risky for a startup that's trying to commercialize a novel reactor design. When you look at their competitors, some of them opt for a much simpler licensing approach. They offload that massive capital burden onto traditional utility partners. That vendor model offers a far, far superior risk-reward profile for shareholders.
I fundamentally disagree. The owner-operator model is the only strategic path that captures the lucrative, long-term recurring revenue of energy sales. It transforms Oklo from a one-time hardware seller into a sustainable energy-as-a-service provider. And crucially, it simplifies adoption for the data center customers. These hyperscalers, they want reliable power delivered under a PPA, a power purchase agreement. They want to buy the energy output for decades. They absolutely do not want the liability or the headache or the expertise required to become nuclear operators themselves. So Oklo takes on the risk, and in return, it captures the perpetual value.
Well, that all assumes a frictionless execution of construction and licensing. You mentioned their plan to mitigate the HELU supply shortage by developing an internal fuel recycling plant. And yeah, that looks great on paper as future vertical integration. But securing the HELU requires licensing a reprocessing plant. And that is arguably the most difficult and politically charged regulatory approval in the entire nuclear world. This introduces another massive time-consuming layer of regulatory overhead that we are already seeing impact their balance sheet.
And what evidence do you have that those R&D and regulatory costs are escalating faster than anticipated?
Just look at the Q3 2025 earnings. They missed consensus estimates. They reported a loss per share of -20 versus a -13 consensus. The trailing 12-month operating loss is already accelerating. It hit about $74 million. These numbers, they're concrete evidence that the regulatory and R&D costs of licensing a novel design and securing a fuel chain are proving more complex and more expensive than the market's initial forecasts. The market cap relies on a perfect, straight path to 2027, and the financials suggest that that path is already getting pretty bumpy.
I still maintain strong optimism on the regulatory pathway, precisely because the AI demand pressure is so immense, it is forcing the government to accelerate. The NRC streamlining efforts, backed by the ADVANCE Act, are concrete legislative steps. More importantly, Oklo is using a very intelligent strategy of iterative licensing for its Idaho pilot site, which is designed to leverage those tailwinds and speed up the approval timeline by proving safety and stability in modular steps. The political environment is the ultimate catalyst here. Solving the energy constraint for AI is now a national priority, and that benefits Oklo disproportionately. It outweighs the current cost escalations.
Political intent can only speed up the process so much. Licensing a new nuclear technology and the infrastructure to fuel it remains a multi-year, multi-billion-dollar endeavor that is inherently prone to delays, no matter which party is in power. The financial performance data just underscores how difficult this landscape is to navigate, and it confirms that the current market cap is still based on utopian execution rather than a conservative assessment of risk.
So the primary tension we've analyzed today really boils down to whether Oklo's exceptional valuation is justified by the political alignment, the technological optionality, and the strategic necessity of this infinite demand thesis for AI power.
And conversely, The counter-argument is that the valuation is fatally undermined by fundamental execution risks, the immense capital required to sustain that owner-operator model, and the structural distortions that are suggested by the extreme market microstructure dynamics, especially that high off-exchange trading ratio.
I think we both acknowledge that Oklo remains a classic high-risk, high-reward derivative option on the future of energy infrastructure. The key watch items for anyone following the stock are going to continue to be the progress of the NRC docket, any successful efforts to secure that HALEU supply chain, and of course the efficient execution of future capital raises.
And until that first Aurora powerhouse is activated and proves it's commercially viable, probably in 2027, this stock is going to continue to be a very volatile vehicle. It'll be driven primarily by narrative, by news headlines, and shifts in sentiment, rather than any traditional operational results.
Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks, don't forget to subscribe to Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.